Hi guys, Vitri Trong, your trusted mortgage advisor. You can find me at trustedmortgages.ca. So today I'd like to talk about how to restructure your mortgage debt to increase cash flow flexibility, which is quite topical nowadays with everyone's financial situation kind of up in the air a bit. So typically, when a client talks to me, I ask them what are their goals with their debt, right? Is it you just want the lowest rate, or do you just want the lowest payment? Or the third one's more sophisticated clients, cash flow flexibility. So how do you structure a mortgage for cash flow flexibility? Well, okay, so the first thing you really need to do is analyze the client's financial situation, what their current debt structure looks like, and look for opportunities to make it more efficient. Right, so let's start with the mortgage. So let's say they have a $300,000 mortgage with a $1,400 monthly payment. Next is a personal line of credit. Let's say they've got $20,000 on that, and they're making $400 a month payments on it. Credit cards, they have a balance of $10,000, and they're only paying about $600 a month on that. And they have another car loan for $20,000 with a $600 payment. So in total, they've got about $350,000 in debt, and they're $3,000 a month to service that debt. Okay, so that's their current state and where they're at today. So next, so it was 350 from the previous strain, and now we're going to take off the savings account balance, right? So if you have all that debt, why on earth are you saving money in a savings account earning pretty much 0%, right? It makes no sense at all. Smarter to throw that $5,000 right onto your mortgage balance, and therefore lowering your total cost of interest. All right. You do want to keep your checking account active because you will need that to pay the bills and a place for your paycheck to go into and all of that stuff. But a savings account doesn't make any sense to keep because they pay next to nothing. So your total net debt at that point would be $345,000 for these clients. So the secret here is to put all of that into a HELOC, right? A home equity line of credit, or a line of credit mortgage, some people call it. Same thing. A typical line of credit right now is 2.95%. That's prime plus half. Prime's really low right now. I don't see prime changing in the next 1 to 2 years. And if it starts to change, then that means the economy is back on the upswing, and we can restructure this to maybe one of the other payment types. But for now, this gives us the maximum flexibility. So 2.95 multiplied by $345,000 gives us a yearly interest cost of $10,178. Monthly, that's $848 per month minimum payment required to stay in your home. Okay, this does not include any principal repayments at all. This is just purely the cost of interest, and you're not making any headway in your debt. But remember, $3,000 a month was what they were paying before, right? So they were okay in managing with $3,000 a month, which means that if you take the $848 off, they've got $2,152 left over, positive cash flow. Now we can really use this to make a dent in either the debt or to start a financial plan or whatever we need to do, right? So let's start a financial plan, right? So pay yourself first, right? The first principle of all financial planning, pay yourself first. So I've got in parentheses there TFSA. Let's start TFSA at $500 a month, right? So before there was really very little savings going on, and now $500 a month. So it's a good start. That's $6,000 a year, which is ironically your TFSA contribution limit for the year, right? So it doesn't have to be a TFSA. This could be like if you needed an insurance policy, this could be an insurance policy. It could be whatever your financial planner and you discuss. Next, let's carve out some money for a principal repayment. So that's $1,500. Why did I choose $1,500? Well, first of all, it's cool that you can choose what you want to repay, right? Every month, there's no set principal and interest payment. It's whatever you wanted to pay. Pretty cool. $1,500, I choose that because if you look at your mortgage statement now, if you look at how your payments break down, it's typically 50-50, right? Half of your payment goes to interest, half goes to principal. So I want to maintain that. If you're throwing $3,000 a month if your debt spend is $3,000 a month, let's make half of that straight to principal. Okay, so that gives us a financial buffer of $152 a month. So, if you don't need it that month for something else, maybe throw that onto your investments. Maybe that's an insurance payment. Or if you really don't need it, throw it at your debt, right? This is a line of credit mortgage that we've got, a HELOC. So every dollar that you throw onto there, you could later on take it back out. So if you don't need that 152, make it a principal repayment for now. You can always get it later if you need it. Okay, so if we go back to that initial slide where we were analyzing the client's situation, we're going to see that their principal payment on their mortgage is $1,400. Let me do that. Right, so right now, $1,400, half of that was going to principal, half of that was interest. Now we've got $1,500 going straight to principal, right? So that's going to make a big difference in how fast they can get that mortgage paid down. So is it magic? Like, how did that happen? It's the same cash flow. How are we able to do this more aggressively? Well, the answer is, if you look down here, there's $400, $600, $600, so $1,600 of payments going to service $50,000 in debt, right? So the personal line of credit, the credit cards, the car loan, all very inefficient, very expensive forms of debt that there doesn't seem to be very much regulation around. So that's another topic that, a little hot button for me, but they've got $1,600 servicing $50,000, right? So we're actually taking that cash flow, rejigging it into the mortgage. So they're going to be debt free and a lot better shape a lot sooner than if they just kept doing what they were doing. Okay, and it's really important to note that what we're talking about here and restructuring debt, it's just debt. It's money that was just going to debt before. We're not taking money from vacation. We're not taking money from eating out Starbucks. Like, we're not doing any of that. We're not talking about lifestyle. This is just the money that was previously servicing debt being restructured more efficiently. Okay, so that should help a lot with those client conversations, right? It's like some people, if you take away their morning coffee, man, that's a non-starter in any financial plan, right? So hopefully that helps you out. Okay, so caveats. So, what do you have to be aware of? First of all, you have to be able to qualify for the HELOC. So HELOCs are a little bit harder to qualify for. And they have some limitations as well. So you can only get 65% of the value of your home in a HELOC, right? So you have to make sure you qualify for that. So talk to a mortgage professional on that. And the second one, you must commit to maintaining your current level of debt spend, right? So if you take the $848 and just that's the interest only payment and you spend the other $2,100, that does nothing for you, right? It doesn't, it actually puts you further behind because you're never paying off your debt. You increased your mortgage debt by the $50,000 in consumer debt, and now you're not making any headway in that. So don't do that. You must commit to spend that debt spend and directing that money back towards debt. And like I said, don't use any extra cash for lifestyle, right? So that principal repayment, $1,500, right? That looks like a really, 3 or 4 months of that's a really nice vacation, right? Let's not do that. You've got other budget for vacation. Don't take it from this, right? Once you're debt free and you've really made a dent in your principal, okay, maybe that's the time where you look at that, right? And I recommend working with a financial advisor. So a financial advisor is going to really be able to do the budgeting and the rest of your finances there. They're going to be able to really set up a plan to be debt free even sooner. There's a lot of borrow to invest strategies. Between you and your financial planner, this cash flow structure should really help any financial plan. So that's it for me. Vitri Trong, your trusted mortgage professional. You can find me at trustedmortgages.ca, info@trustedmortgages.ca. Drop me a line. Talk to you soon.